All right, so today I wanted to make a video on what I think is quite possibly Warren Buffett's best piece of investing advice. I do have the video here. I will play it. The quality is not very good, but the audio is all that matters. So I'll give it a play, and then I'll talk a little bit about it.
Gotten rich on their best idea. Yeah.
Omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. You know, it's easier now than ever because you can do it online. You know, just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life. You would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Yeah, so this is a very good point he makes, and obviously it's a hypothetical thing. I'm not saying literally, and I don't think he's saying literally that you should do this, but the point is very simple, that you should spend more time deciding on what you should invest in than people are doing. This is a mistake that I've made obviously a lot, especially early on, not as much anymore, but I think that you are the best off to find a small amount of companies and watch them like a hawk, right? Listen to their earnings calls. It's something that I'm starting to do. Just know everything you can about them, right? I mean, you should be able to rattle off numbers just off the top of your head, right? And that's a good thing, right? Because if you're more careful with what you invest in, well, you're going to be more successful, right? You're just going to be more successful, right? I mean, crypto is a good example of this as well. Like when I first got into it, I was dabbling in probably 5 to 10 different cryptos. Now it's like I'm just almost like 95% in Bitcoin, right? And if anything, that number is probably going to go up over time, right? So I think that you are best off, and obviously Warren Buffett believes this as well, to be more, I'm not saying you're super concentrated in one position, right? You definitely should have some diversification, but a lot of people over the course of their life, you know, you'll buy 500 or into the hundreds of different stocks and all these ETFs. And again, a lot of people, I think they take this too far and it's like, yep, just buy the S&P and go away, or, you know, just buy the Qs, buy this ETF, buy that ETF. And to me, that also doesn't make sense, right? I think that if you're not willing to put the time in, yeah, you probably should be getting someone else who's a professional to manage your money, or just buy the broad market and go away. If you're willing, and you don't need to put that much time, like you don't need to be spending, you know, hours every day or even every week. And in my opinion, it's like once you have those fundamental positions, it takes less time, because once you have those top positions in place, well, you spend less time needing to find new stocks and more time keeping an eye on the existing ones, right? And I'm also not saying that once you're in these positions that you just stay in them no matter what. You obviously need to have your hypothesis in place and saying, okay, well, this is what I want, all that kind of stuff. And this is what would cause me to sell, right? I mean, if they start diluting to a large degree, if they're, you know, free cash flow growth, or, you know, whatever it is, if they get too expensive, I mean, then you probably would just hold. But again, you need to have done this thought process ahead of time. And this is also why I'm very skeptical of shorting the market, or, you know, buying, you know, out of the money, deep out of the money calls or something like that, because, you know, right now everybody's bearish, right? Everybody's talking recession, recession, recession. You know, there's going to be this big crash. Well, again, like I've brought up before, if everybody's expecting something to happen, well, chances are a lot of that is already priced into the market, right? And number two, let's just say it does happen. Well, when is it going to happen, right? Because yeah, the yield curves and all this stuff can be predictive, but they don't predict timing, right? And they're not going to tell you how much, right? And again, when it comes to, like, let's just say there is, let's say the market goes down 10% next week. Okay, well, it could go down another 10% or even 20%, right? Or maybe the Fed steps in and cuts rates, and Congress steps in and has a giant stimulus again, and the market shoots up 10, 20, 30% over the next month or two or whatever, right? We just do not know, right? Nobody knows the short-term direction of the market, right? And the other big problem is, okay, let's say the market goes down 20% and you have put options. Well, when do you close those out, right? Because, if the market goes down another 10% or 20% and you close them out, well, you're going to feel pretty bad. Or maybe it goes right back up again and you're stuck with no profit at all, right? Or maybe you're down. So that's another important thing to reiterate. But I think the main gist of the story is be more careful with what you invest in, right? A lot of people are way too willy-nilly. A lot of people, they're trying to trade, they're trying to time the market, and to me that just makes no sense, right? To me that just makes no sense, because the Warren Buffett strategy of investing, which is essentially buy good quality companies at a fair value, or preferably when they're cheap, over time, that's going to do very well. Trading, whatever the new strategy is, it might work for a short period of time, but there's no long tested period to where that's a good idea, right? I mean, like when you think of the concept of investing, like who thinks of a day trader? Pretty well no one. But when you hear the word investor or stocks, people immediately think, Warren Buffett, Ray Dalio, these kinds of people, right? I mean, you could rattle off a list of, 10 or 20 names, right? And is a day trader ever going to come up for the average person? Like, no. And again, I'm not saying that there's no successful day traders, but I just think it's harder because, again, the Warren Buffett strategy is it's not actually that hard, right? It just takes, the hard part is the discipline, right? Because you see these hot new, high flying tech stocks that are super expensive, but again, you're the ones that are going up, so you got to buy them, right? Or again, where there's a crypto bull market, so you got to buy this small cap whatever, because oh my god, it's went up 100% in the last week, and it's went up 100% the week before that, right? Or the latest meme stock, right? I mean, I never got into the meme stock stuff because, I mean, I always thought it was kind of stupid, and again, there's no fundamentals behind it, right? Anything could happen in any day, and then when you look at Bed Bath and Beyond now, it's going out of business, right? So, if you buy very good quality companies at fair value, or preferably when they're cheap, which again, that is pretty easy to find out. Again, you can see the historical price to free cash flows, PEs, price to sales, et cetera, et cetera. That stuff's pretty easy to find. And again, you can easily find, return on equity, free cash flow growth. Are they buying back shares, right? I mean, all these metrics that point to good companies. Like, this stuff's not that hard to find. Again, there's obviously intricacies involved, right? There's definitely intricacies, but I don't think it's that hard at the end of the day. The hard part, and I would acknowledge this is very hard, is the discipline, right? That is the hardest part. The hard part is not finding good companies. The hardest part is the discipline, right? To wait till they're cheap. And then when they do come down, to not have this fear of, oh, it's going to go down further, it's going to go down further, it's going to go down further. Like, no, all you should be cared about is it cheap? Like, if it's well below its historical average and nothing fundamental is changeable to business, right? All the metrics still look good. Well, why would you not buy it, right? So that's the hard part. So anyway, just wanted to make a video about this because I think it's a very good point, and I don't think enough people put enough thought into this. So Anyway, if you liked the video, hit that like and subscribe, and stay tuned for more.